Alrighty, welcome back to day 4 of the Traders Induction program here on my channel. Thank you very much for your time. Today we're going to be discussing the position and the order types in the markets, and this is quite the important understanding when it comes to executing positions against your broker. So what we're going to do first up, position types, we are going to cover the long position. Now, a long position is an execution within the market where the price moving higher than the entry price of the position results in a profit. So we're bullish on this market. We execute a long position with the expectation that the market is going to run to the upside, and we're going to get a profit from it doing so. Now, we have a little example here, which you'll see throughout the rest of the video. This is our market that is heading to the downside. We reckon it's going to bounce, so we throw on a long entry. We bid this market at a discounted level with the anticipation that the market's going to bounce, and we're going to capitalize on that move to the upside. Lo and behold, the technical analysis was correct. We are now in profit, and we are making that money from the price moving to the upside relative to where it was at the time of our entry. Now, heading over onto the opposing side, we have the short position. And a short position is the exact same as a long, but flipped. And that is an execution within the market where the price moving lower than the entry price results in a profit. So we're betting against the market. We're betting that it's going to head lower, and we want to capitalize on that. So we're in a bearish stance. Now, again, with the same example, price is ripped to the upside. It's starting to stall. We reckon it's going to turn around and head back to the downside. So yet again, we want to capitalize on this. And the way in which we do that is we throw on a short position at the top of this run up here with the expectation that the market's going to go to the downside. So we've executed. Lo and behold, the analysis was correct once again. The market has reversed and headed to the downside. We're now making money as the market decreases, getting that cash. So moving on now to the third and final position type, which I believe is arguably the most important position type that a trader needs to understand and know when to utilize it as a tool, and that is a neutral position, and that is no execution. It is sitting on your hands when there is no position that is justified in the markets. Knowing when to execute in the markets is one thing, but knowing when not to execute in the markets is a completely different skill in itself, and in my opinion is what separates the good traders from the bad traders. The damage is done between the positions that you are taking. So when there is no position that is justified, there is no edge, there is no strategy, the markets are choppy, they're moving sideways, it could be doing this, it could be doing that. Having a neutral stance and having no position in the market is a position in itself. You're favoring your capital to deploy at a later time when that edge does present itself. So very important, and one that is often overlooked. Order types now we're moving on to. These are the more practical execution methods against your broker when it comes to getting into the markets, because there's a few different ways one can do that. First up, we have the market execution, and that is executing a position at the current market price, factoring in the spreads. So we like where the market is currently trading at. We don't need to wait for any more confirmation. We just want to get in and see what happens, so we can utilize a market execution in this point. Now back to the example. We've had this nice rally. We've hit a nice level of resistance. The market seems to be slowing down. We're betting that it's going to head to the downside, so we just want to execute the market where it is. It's at a nice price point. We don't need to see too much more, so we jump in. The way we do that is we market execute at the current trading market. You will get filled roughly where the market is currently trading at. Now, the reason that I said factoring in spreads is that when you execute a market order, you're going to get filled at the next bid or the next ask price that I touched on in my last video or the video before that. So in markets where it's in markets that have a very deep liquidity to it with good brokers, you don't have to worry too much about executing a market order and then getting filled so far away from where the market's trading. But on those thinner markets with less liquidity, such as the meme coins and the lower cap assets or crypto tokens, for example. You could market execute an order, but then get filled at the next asking price, which is the lowest price the next seller in the market is willing to sell the asset for, which could be 50% away from the current market price. So now you're down already on the position just for getting into it by market executing. Now, the way in which this can be mitigated, we'll cover in the next bit. But lo and behold, on this position, we got short at market. Very nice entry point. The market has gone to the downside. We're happy and we are making that money. So now moving on to the second order type, we have a limit order. And now what a limit order is a pending order set at a distance away from current market price, which will execute when the market hits it in anticipation of price reversing. So, for example, going back to our example here, we have the market has fallen to the downside. It's starting to pull back up into our area of interest. We don't want to market execute here because it's a little bit too discounted. We want it to come up a little bit further before we can justify the entry. So what do? We set a limit order short above the market, waiting for the price to come up and hit our entry before reversing and falling short. Okay? So it's setting an order above the market, anticipating it to come up and then reverse in our favor on the short side. That is obviously flipped when we're looking at a long position. We would be in a long position, we would be setting a limit order below market with the expectation that it's going to come down, hit our entry, and then reverse and head back to the upside. So that is a limit order. Lo and behold, price moves up to our limit order. We get our fill price at the specified level. You don't have to worry too much about the spreads here. When you set a limit order, chances are you're going to get filled at that order if there is the liquidity available to you. And in this situation, yet again, your analysis has been correct. You have got a very good entry price and you make the profit on the decline in price. This can be very helpful and very handy when it comes to availability at the charts. Maybe you don't have the availability to set an order to execute live. Maybe you're at work, maybe you're busy, so you find a nice area of value in the markets. You throw in a limit order and you just wait for price to come up to that entry and then tag you in before heading in your direction. So moving on now, we are going to the third and final, which is a stop order. It's another pending order set at a distance away from the current market, but in the same direction as price is moving as it executes the order. So instead of we're waiting for the market to come up, hit our limit order and then reverse, what we're doing is we're looking for the market to come through our order and then tag us in as a continuation of that market moving. So again, with the example, we have a nice rally to the upside. We're looking for that retracement to the downside now. So with a stop order short, this order needs to be set below the market. That's going to take us in as the market heads lower, like so. Now, these are very handy as well in trending markets. When you've got price getting stuck above and stuck below levels, you can be taken in on the breakouts, for example. They can be very handy in that. You're catching the continuation of the move, or expecting that if a market does come to this price point, it's probably going to continue in that direction, so you can utilize a stop order. I personally don't use stop orders. I haven't done so in a very long time. I stick with the limit orders as secondary and the market executions as a primary execution method. It's the stop orders can be good for the breakouts if you want to set them at recent highs. Just as the market goes and breaks through a new high, you just get filled straight away and then take that to the upside. Lo and behold, again, the analysis was correct. The market tanks. You are now executed in the position. So they're the three order types. And now, in summary, we have gone over a few of the position types. We have the long position. We have the short position. So we are either betting to the upside or betting to the downside. And we also have the third and most important position, which is the neutral position. No position. Sit on your hands when there's nothing to do. Next, we're moving on to the order types. So these are the execution methods. We have a market execution when we like where price is at and we just want to get in now. We have a limit order when price still has a little bit to move to the upside before taking us in and then reversing to the downside. So limit orders are very good and a much more passive way to execute the markets. And then the stop orders are the continuations, basically. But the market is moving in one direction. If it comes a little lower, I want to execute there because it'll probably continue lower in that way. So stop orders, again, not very often used, but still a very important execution method nevertheless. Now, next up, day 5, we're going to be covering the basic technical analysis. This is going to be a bit more of a practical one of me bringing up my charts and just explaining some of the different factors and features within the charting software that I use, which is TradingView, as well as some basic price action principles and technical analysis, and how we can build a narrative based on the price fluctuations on what can happen next, and then actually capitalizing on that analysis. So thank you again very much for your time. I hope you enjoyed this one. If you did take some value away from it or have any feedback, please leave a message in the comments below, and I'll get back to you as soon as possible. Thank you.